The US and Iran talks have already ended and they did not lead to an agreement. And we are already seeing its impact on the financial markets. We are already seeing its impact on the indexes, on oil, and on gold, even on the weekend through the hyper liquid chart provided by the MRKT terminal. Here we can see SPX initially jumped on the weekend on Saturday, obviously on the hopes of optimism, on the hopes of talks between the United States and between the Iran, mediated by Pakistan. And at one point SPX was trading near the 6870s, but as of now, as the talks have ended and they did not lead to an agreement, SPX has erased all of those gains and is trading around 1% lower than its closing price on Friday. And what is the reasoning again behind this? Obviously, Iran deal collapse rises the Strait of Hormuz closure risk. So the oil risk, the inflation risk, they are back in the picture. The risk related to the supply of oil, disrupt oil supply, spiking energy cost, inflation, they are back in the picture and they will be acting as a negative catalyst for the US indexes. Geopolitical escalation could trigger risk of environment in the markets, and oil prices spike from the Hormuz tension could derail growth as well. Obviously, when the inflation is rising, when you are expecting higher interest rates, it can slow down your growth and the labor market as well. And all of this is going to directly impact or act as a negative catalyst for the SPX. Now, I won't go in too many details of the things of the ceasefire situation and of the talks that what happened, because we already discussed in our latest YouTube video which I shared on Friday. And after watching this video, if you want more details, you can watch that video out. I already made a post about it on my X account as well on Friday before the market close, so you can check it out if you want more details. But the point is that what we are going to discuss here is some trade ideas. What we are going to discuss here is some potential trade setups, discussing the current macro picture and how all of this can move the financial markets going into the next few days and weeks, right? So we have already seen the SPX, we have already seen the fundamental factors on the SPX. I have taken a trade on the SPX too. I will show you it as well and my base case or my narrative on it. Okay. But before that, I would like to talk a little bit about oil. And the same thing which we just saw on SPX, the same thing happened with oil as well. Again, we are on the hyper liquid chart. Oil prices initially on Saturday they moved lower. They erased some of their gains which they had earlier in the few days, in the few weeks, and there was some optimism in the markets related to the talks and all of that stuff. But again, as we did not reach an agreement, oil prices, they recovered all of their losses, they erased all of their losses, and now they are trading even more higher than that than earlier. Okay, they are up around 5 to 6%, something like that. And the reasoning is again the same, that Iran and US talks have failed. IRGC is restricting the military vessels in the Strait of Hormuz, negotiations had stalemate over the Strait of Hormuz and all of that stuff, right? So again, the point is very simple. There is no ceasefire, there is no agreement, and what it simply means that we are going to see renewed geopolitical escalation. This narrative is more likely to happen than anything else, right? That is why, due to the supply fears, due to the Strait of Hormuz situation, oil prices are moving higher as well as of now. And again, if we talk about gold now quickly, we can see almost the same thing on gold as well. You can see the day trading narrative or the bias on gold is now bearish, and gold prices are moving lower as well, again due to the inflation fears, because higher oil prices will lead to higher inflation, higher cost, higher energy cost, higher you can say transportation cost, production cost, raw material cost, and they will feed directly into your inflation. And if you have higher inflation, you can see higher interest rates, and that is not a positive thing for gold, because gold is a non interest yielding asset, right? And again, if we see the fundamental factors supporting the day trading bearish bias for gold, it is again going to be the same thing, because this is the current macro picture. Okay, this is not a short term picture now. This is a current macro picture in the markets, because it is directly impacting your inflation, it is directly impacting your monetary policy, your fiscal policy, your economy, your growth, and that is the stuff which is included in your macro, right? That is why is a big picture now, and keeping an eye on this, understanding it is going to be very important. The same stuff again, Iran is not in any type of hurry for the negotiations. IRGC threatens the military vessels. No Hormuz change without the US deal. Negotiations hit stalemate over the Hormuz. Iran red lines include Hormuz as well, reparations, compensation. Again, the same thing. renewed the expectations of renewed geopolitical escalations. Now, just a quick point here, okay, just to make it even more clear for you. We do not have agreement. We do not have any more talks, at least as of now. What it simply means, this will mean that the Strait of Hormuz will remain closed, right? And this will mean we will continue to see more oil disruption. This will mean we will see more higher oil, and this will feed directly into your production cost, into your transportation cost, into your raw materials, and all of that stuff. And they will lead eventually your inflation higher. And if you see higher inflation, it will mean to control that inflation, you will need to increase your interest rates as well, right? And if you will increase your interest rate, it will act as a negative catalyst for gold, because gold is a non interest yielding asset. And at the same time, it will act as a negative catalyst for the US indexes. Why? Because they don't love higher borrowing cost, because it will reduce their profits, it will reduce the liquidity, it will reduce the injection of money into the markets, into the companies, it will reduce their expansion, it may even trigger them go into a contraction territory, right? And higher interest rates, they will directly impact or derail your growth and the labor market as well, right? So this is the summary. And the market impact, you can see the market impact already from our MRKT terminal: negative gold, negative the US indexes, and higher oil. This is the simple base case narrative right now. And if we see the same thing for the DXY can edge higher as well, because again the same thing, we have some uncertainty in the markets, we have some higher inflation expectations, we are expecting more and more rate hikes, rather than rate cuts going into the future. All of this narrative is going to support the dollar index as well. It will support the dollar against the pound, it will especially support the dollar against the euro, right? So you can, maybe the narrative for the euro USD, let make it a little bit more clear. The narrative for euro USD is going to be bearish for the next week, as long as things remain like we have currently. Okay, so for the DXY is currently trading at a pivotal support area, at a pivotal demand area, and this has held for the last few trading weeks, last few trading days. This is also the lows of a consolidation, and I believe if the things remain the same, okay, as they are right now, then DXY can very well head to the 100.5 levels, and even move higher and test the 101.5 and 102 range. Okay, now you can do whatever you want from this information, right? Because higher dollar is going to act as a negative catalyst for the euro USD, act as a negative catalyst for the pound, right? I hope you are getting my point. Right. So this is the situation right now. Now I will show you my trade on the SPX as well. And I took this trade on the weekend, a little bit before the weekend, obviously not exactly on the weekend, a little bit before the weekend. And my idea was again the same, which I shared in this video, in my recent YouTube video. And in that, I told that this is the general supply area between the 6800, 6860s, at which I'm looking for possible sells on the SPX, targeting first this demand area and then very likely the recent lows. Okay, so this is my narrative on the SPX, and my narrative still remains the same. I remain bearish on the SPX, and the reasoning, again, as I told you earlier, the reasoning remains present here, with the Strait of Hormuz disruptions and all of that stuff which I have already told you. Now talking a little bit about gold as well, just a bit quickly. I'm busy in a wedding, and I have not been able to remain that to be that much active right now, to make some more long form videos, more detailed videos. But once I will free, I will be doing that as well. But for now, just quickly, gold again, as I told earlier in my earlier video, gold is in apparently gold is in a lower lows, lower highs pattern, lower lows, lower highs pattern. And in the short term, to be very honest, in the short term, I am a bit sidelined on gold. I think that gold prices can very well head lower even more. We can see even more discounted prices in the gold going into the next few days and weeks. Again, due to the higher inflation expectations and due to higher interest rate expectations. But I am a bit sidelined on gold, because in the medium term and in the long term, I remain bullish on gold. Why? Because of the strong central bank demand, because of the strong demand from China, because of the fact that if we see higher interest rates, they will directly impact your growth and the labor market. And clearly, our growth, the growth of the American economy, and or even when you talk about the whole world, the growth has been not so solid recently. The picture of the labor market has not been so solid recently. And if higher interest rates, they like the Fed, they does the or the other central banks, they push up their interest rates, they do some rate hikes to control the inflation, it will directly impact in a negative way your growth and the labor market as well. And that can push you very clearly in a deep stagflation environment. And remember, stagflation is going to act as a positive catalyst for gold. Right now, the focus is the inflation. The focus is the higher interest rates to control the inflation. Okay, in the short term. That is why in the short term we can see more downside in gold. But if we really do some higher interest rates, I believe they will be directly impacting your growth, they will be directly impacting the strength of your labor market, and they can very well push you into a very deep stagflation environment, which will eventually in the medium to long term act as a positive catalyst for gold. So in very simple words, I am looking for discounted prices in gold to buy the dip. Okay, maybe at the $4,000 levels, maybe at the $3,800 levels, or maybe even lower around the initial all-time highs of 2025 around the $3,500 levels. Okay, so these are my point of interest, and I am looking to accumulate gold both from an investment perspective and a trade perspective as well. I'm looking to buy gold, as in the medium to long term I remain bullish on gold. And that is exactly why I'm not looking for some short term sells on gold, because they conflict with my medium to long term narrative. Okay, that's why I'm a bit sidelined. But overall, I do believe with these higher inflation expectations, higher interest rate expectations, we can see some more downside in gold, some more better discounted prices before we eventually move higher towards some new all-time highs, or eventually towards the $6,000 levels by the end of this year, or by the maybe the second half of the next year. Okay, that's my narrative on gold. On the US indexes, as I told you earlier, I'm currently in shorts and I remain bearish on them. The reasoning is simple: higher interest rates to control the higher inflation. Higher interest rates are themselves negative catalyst for the US indexes, for the US stock market, or even worldwide, right? No, doesn't matter. uh, even if you're from Pakistan or India or somewhere else in the world, if your central bank is raising the interest rates, it will directly impact your stock market in a negative way, because higher interest rates mean higher borrowing cost, right? In a very simple way. So due to the higher interest rate expectation, I remain bearish on the SPX. But there is one more thing: if you do higher interest rates to control the inflation, again you will impact your growth and your labor market in a negative way. You will hurt your economy, you will hurt your labor market, and that will erase or fade away the confidence of the investors. They will pull their money out of your economy, out of your stock market, because they are not feeling safe anymore. And if that growth narrative happens, I also want to tell you one more thing: if that growth narrative happens, it will push the real yields down as well. Okay, and if the real yields go down, then they will act as a positive catalyst for gold again. So this is a big macro picture forming right in front of us, a very big macro picture which is forming right in front of us. And if you will not stay ahead of time, it will if you will not stay objective, then you are going to lose hell lot of money, to be very honest. Okay, so this was my narrative on the US indexes and on gold. Now talking about oil again, as you can see, I was looking for some longs, but with the current developing situation, I believe that I have missed this entry for that time being. Okay, so overall, I believe oil prices can going into the next week, if the situation remains like this, if we don't see any fresh optimism, which is obviously again very unlikely. Uh, like seeing some fresh optimism is very unlikely, right? So I believe that oil prices can very well head higher next week, and even do a wick fill around this $120 per barrel level. And again, due to the supply fears, due to the supply disruption, we are expecting higher oil. And let's join the dots now, connect the dots now. If we are going to see higher oil, we are going to see higher energy prices, higher production cost, higher raw material cost, higher transportation cost. They will feed directly onto your inflation. They will weaken your growth, they will weaken your labor market, and on top of that, if you will they will weaken the demand as well. Okay, and on top of that, if you will raise your interest rates to control the inflation, it will have even more of a negative impact on growth and on your labor market. Now, I'm not a boomer and I'm not dumb as well. At the same time, I'm not calling for oil prices to hit like maybe $500 per barrel level or something like that. That's not the thing, because oil can't simply go that higher. Okay, no one can afford that uh, oil at that prices. I'm not even calling for a $200 per barrel oil. Okay, maybe we can trade somewhere in between a range of $122 to $150 per barrel level. The thing is that if the oil prices remain elevated at these prices for a longer period of time, and even if not these prices, okay, even if these prices between 90 to 80 to 120 something like that, if they remain here for a longer period of time, they will increase your costs too much, because so far we have not seen much of an impact of the higher oil elevated oil prices directly into our inflation or production cost, because we have not gotten the updated data just yet. Okay, all the data was of the previous month and oil was not elevated or at these prices for longer at that time. Now it has been a month, since then, a little over a month, and now we can see direct impact, a very big impact of oil into inflation, into your production, transportation, right? Everything. And if they remain elevated here for longer, even if they consolidate here, it can hurt the economy, the inflation story, the soft landing story, each and everything. It will disrupt a lot of stuff, right? So this is a very wild story which is being formed, but a very big macro picture at the same time as well. And you will need to keep your eyes open, and you will need to stay ahead of the curve. And for that, you can use this mrkta terminal as well. You will be getting the live news, the market impact. Let's say you don't understand that what a specific headline means. Okay, so you will be getting a market impact as well. By clicking on this brain icon here, you will be getting a AI generated analysis of that headline here as well, again along with the market impact. And here you can already track the prices on the weekend as well, with the with your higher time frame bias, intraday time frame bias, pullback area, target level. Here you have your AI generated analysis and your fundamental factors at the same time. You can also get a market sentiment index, Trump tracker. Like there is a lot of stuff, right? So you can use some this as well to keep you ahead. I use this for my research. I have been using this for a long time, and I will drop its link in the description and you can check it out if you want. Also, for the updates, I will be updating if anything new happens on my public Telegram account and on my public Twitter profile as well. I will drop the link in the description and you can check them out if you want. And at the same time, we have also updated our verified track record inside our public Telegram group, and it will and we keep updating it every month and share it every month. It will include verified P&L statements from our public trading account, and all historical P&L statements are available in the pinned messages in the group. Okay, so you can check it out if you want. I will drop its link in the description as well. And this was pretty much it. If you have any questions, you can let me know, and I will try my best to respond to them and give you a structured answer, right? Best of luck for the rest of the trading week, or best of luck for the upcoming trading week.